Something big is going on in the market. The S&P 500 just closed out an incredibly bullish week led by technology stocks and Tesla. After hotter than expected non-farm payrolls sent yields lower, bonds gained, stocks gained, and here we are up nearly 2% for the week. So have we entered peak bullish territory, or is this the last hurrah before the massive sell-off? That's what we're here to talk about today. So buckle up, we've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks in the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's dive in. This is the daily heat map of the S&P 500. A lot of green, a lot of red, but a lot of green in the big names. Microsoft, Apple, Google, and Meta up 5.87%. Absolutely crazy. I believe back to all-time highs, one of the biggest positions in my portfolio. So to see this is actually really great. We saw, again, continued momentum in Tesla, Amazon, Walmart, Costco, Eli Lilly, AbbVie. Today was really a day for growth, and market breadth did improve throughout the day. It was pretty atrocious at the start of the day, but it did improve towards the end of the day. Nvidia was very, very red while the rest of tech was green. Very weird to see that price action along with AVGO, but semiconductors for the most part was actually fairly upbeat. On an equal weight basis, I guess you could say semiconductors were fairly green. We saw mixed price action here in financials, industrials, as well as commodity driven sectors. Now the worst performing sector was XLE energy, as well as regional banks, metals, right? Home construction, home builders, essentially, industrials, and financials. So there was no real pattern you could see in the sectors that were losing here today. One thing we did note is that growth outperformed for the most part. And even when you see a name like XLP, this was mostly driven by the gains we saw in Walmart as well as Costco, which are really just like growth stocks in the consumer staples index. They are some of the biggest weights in that index, and that's why staples was up there. But growth across the board, we saw GDX, okay, up 2.81%. That actually had to do with rate cuts with some of the data we got today. We're going to talk about that a little later. But yeah, it really was a day for growth. Look at XLC, IGV, XLY. These are all really growth sensitive sectors, all outperforming the SPY, which gained 0.58%. Now the SPY gained here today after we got some of the non-farms data. The data was actually very, very mixed. So we actually beat expectations in payrolls, posting numbers of 206K against the consensus 190K. But the unemployment rate actually increased to 4.1%. The expectation was 4%. And that's because the April and May numbers got revised to the downside. But other than these two figures right here, average hourly earnings year over year came in line. So did average weekly hours and average hourly earnings on a month over month basis. So very, very mixed results here from non-farms. And this is definitely telling us the labor market is loosening. And after the non-farms result, what we did see was a definite cut being priced into the market here in September. And actually 2 official cuts, or 50 basis points worth of cuts for 2024. Whether we were getting 25 or 50 basis points was really still up in the air, but it looks like we're probably going to get a federal funds rate of 475 to 500 basis points after that non-farm print. So yes, non-farm did come in hotter than expected, but the unemployment rate did tick up. We do know that's what the Fed's looking at, as well as the wage inflation metrics, average hourly earnings. And that's why the market is now officially looking at 50 basis points worth of cuts, or 2 cuts into the end of 2024, when previously it was just one 25 basis point cut, and the first and the next cut coming here in this January period. And that's why we saw the price action that we did today, with yields moving lower, down 1.49%. Commodities gained across the board. Gold was up 1.47%, silver up 2.7%, and my silver position, which I bought here at $29, looking very, very good right now. We're clearing some of these key levels, and commodities looking really, really strong. And oil has already made its move up, sort of balancing here at this 84 range. But the talk of the town was the S&P 500. Look at this chart. Is that not crazy? This is the year-to-date chart in the S&P 500. Incredibly bullish, but that's generally what happens in July. In July, we normally see the first 5 to 10 trading days, we see a huge move up. It just comes with the second half portfolio rebalancing. And in a positive gamma environment where there's a lot of positive flows, you want to be buyers of dips. And the goal here is to get to the 5,600 area. That is our target into the July OPEX. But there's a couple of things I want to bring to your attention. Now, we got a couple of indicators right here, and let's have a look at the RSI. And in a video a couple of days ago, I spoke to you guys about what happens when stocks stay in overbought conditions for an extended period of time. In the short term, overbought conditions in the RSI can see a little bit of downside, but if we stay in the overbought category for a while, that's actually bullish in the medium term. This is what we're seeing right now. Stocks are overbought. This is not a reason to get bearish. This is actually a reason to get ever more so bullish. At the same time, looking at the advanced decline line, as the S&P 500 continues to make new all-time highs, you can see that market breadth, while it has improved, did come down as the S&P 500 did move up today. But if we actually dive into the RSP, it actually tells a very different story. The equal weight actually saw a big move up after we saw huge buying at the lows in today's candle. Look at this candle. It just finished in the red, but there was some very strong buyers, and at this 162 163 level we're seeing some very strong buy side support, and I do think this is probably the zone we're going to hold and move higher to new all-time highs as the market broadens out as we enter Q2 earnings. But the S&P 500, let's dig a bit deeper. So market breadth, not looking bad, but not looking great either. I would call it middle of the road. It happens especially when we do get mega cap leadership like we are seeing, but the weekly chart just closed out, and this is very bullish. Higher highs, higher lows into a new all-time weekly closing high. That is bullish. If we are to pull back in the S&P 500, there's plenty of support levels. First one is here at 52.65. The next one is obviously here at this 49.82. Let's just call it the 5,000 flat level. So there's plenty of support areas if the S&P 500, is to pull back, which would still keep the market in a very bullish trend. And when you look at this, right, even if we are to pull back to some of these key support levels, we could see a pullback as much as 10% and then continue the move upward. Now, diving into the daily chart just a little bit more, look at these three green candles, right? Looking at candle structure and location, new all-time highs. Each of the candles in the last 3 days closing at the high of the day, which means buyers are coming in and just buying. And if you actually look at the 5-minute chart, this was kind of crazy. So the 5-minute chart in the last 5 days, yeah, we did see a little bit of volatility here at the start of the week. We then formed a bottom, and it's literally been one-way traffic, no rest for the bears, relentless price action, relentless algo buying to the 5,567 area. And I don't really want to fight the trend right now. The aim, what we are aiming into July, is the 5,600 area. That is our long-term target, and we want to be buyers of dips at the 5,500 area. I do think if we do pull back, we'll find support right here and continue to move higher. This literally looks like a breakout. We're breaking out, and the target is 5,600. So you want to be long. I said to buy here at the 5,200 area. I said to buy here at the 5,000 area. These were places I was shouting buy. I was screaming buy in my daily videos. Go ahead and have a look at them and look at where we are right now, 5,500. I do think that we're going to finish the end of the year anywhere between 58 to 5,900, somewhere in there on a very bull case, maybe 6,000. Buy the dip, don't trip. And when I say buy the dip, right, you shouldn't really be buying at these levels. You should already really be positioned. If you are looking to buy, I would probably look at something like small caps, the SP 600. That's what I would look at. But if you're looking at the larger cap names, you should already be positioned, and you should just be riding the wave. So what does this mean for next week? Well, next week, if we pull back to the 5,000 level, that would be a strong place to buy. We do get CPI data next week. So the 5,000 level is the buy zone. Other than that, I think we're just going to continue to drift higher into the 5,600, where we'll see algos just relentless buying to the 5,600 area. At the 5,600 area, that's when we could see a little bit of downside. And again, I would cap downside at the 5,500 area, possibly as low as like 54.45 if we really do get there. But seasonality is on the side of the bulls, and I wouldn't want to fight the trend right now. Now, looking at market sentiment, this is the AA sentiment survey, and not much has changed from last week. What we did see is a slight decrease here in bullish sentiment, a slight decrease in bearish sentiment as well. So people just getting a bit on the sidelines. I think when the market does what it's currently doing, sort of just making higher highs, new all-time highs, just this slow stair-step grind upwards, the type of market movement we see in positive gamma, that can really affect the bears, but it can also really affect the bulls. And I think what that does is it just makes both sides cautious, and that's exactly what we're seeing right now. That being said, look at the bullish sentiment compared to the historical average, well above the historical average, and the same is true here, bearish sentiment versus its historical average. So this is a bull market. People are bullish. There are more bulls than the average. There are less bears, and this isn't a contrarian signal. This right here is just a reason to get ever more so bullish. So I often say that momentum brings momentum, and this right here is a summer rally setup we've been looking at for the last couple of days. Now, the fourth rally is done. It's actually a very bullish period to go from the June post-OPEX week to the 4th of July. Average returns 1.1%. But now the 4th of July is done, and we could actually look at the next leg of this rally, which is July 4th to the 11th. Not quite as bullish as the first period right here, but we normally get 11 wins, 7 losses. When the second quarterly OPEX is positive and the June OPEX week is negative, we could see average returns of 0.48%, median returns of 0.57%, but it gets ever more so bullish because after the 11th to the 18th, we could see returns in that week of 1.2 average and 1.04 median for a full return over the next 2 weeks on average with regards to the setup being 17 wins, 1 loss, 2.79% average return. So to see about 2 to 3% returns in a 2 to 3 week period, very, very bullish. You want to stay long because I do think the market is probably going to go higher. Sentiment is on the side of the bulls and the data also supports this. So we're going to talk about Q2 earnings season. Q1 is officially done. Today was the last day. All 500 S&P 500 companies have reported, and now we are on to Q2 earnings from next week, and everything kicks off on Thursday. We have Pepsi before the open, as well as Delta Airlines, and then JP Morgan Chase, Wells Fargo, Citi, BNY Mellon here on Friday. So a couple of big names with regards to the consumer on Thursday and a couple of the bigger banks, and that is getting Q2 earnings off to a good start. If you want to know what the Q2 expectations are, go ahead and watch yesterday's video. We spoke about earnings for all of the sectors in the S&P 500 as well as revenue expectations. But for earnings in today's video, we're actually going to talk about calendar year 2025. So we are at the halfway mark into 2024, and this probably means we really need to start talking about 2025 earnings and what that's really going to look like, because a lot of the fund flows that we see from Q3 and Q4 onward is actually the market pricing in Q1 2025, Q2 2025 earnings. So let's take a bit of a deep dive into overall calendar year 2025 earnings. What are our expectations and how have they been developing? So 2025 earnings are very, very aggressive. 14.4% for the total market. Every single sector is seeing earnings growth. The lowest being real estate, consumer staples, and utilities, seeing 5.6, 7.8, and 8.6% in earnings growth respectively, and the best performing sector being information tech, growing at 19.5%, then healthcare and the materials sector, which is kind of crazy. If you actually look at this, the comm services sector, so Meta, Google, Netflix, Disney, growing at 13.2%, and that's actually below the overall market earnings. So very, very aggressive earnings growth here for the entire market. And if we actually have a look at how earnings have been developing as the market has rallied this year, this is March, this is where we are right now, we can see that earnings have actually been revised to the upside, not aggressively, but they have been revised to the upside regardless. We've seen a little bit of a pullback here that has coincided with the S&P 500 moving lower. We do know that we are back at all-time highs at the moment. And overall, if you go from March to where we are right now in July, we are seeing upward revisions. Now, the major contributions to those is the communication services sector being revised up 3.2%, tech up 2.6%, and the consumer discretionary sector up 2.5%. And these are three very large sectors. If you see upward revisions in these, you're going to get overall upward revisions in the S&P 500. But at the same time, we have stuff like energy, materials, they're getting revised to the upside. So commodity driven sectors, the market realizing that rate cuts are coming and commodity prices will move higher. That tends to happen when we do get easier monetary policy. And so the market is positioning for that. And we're seeing upward revisions as a result. The S&P 500 overall is seeing a 1% revision to the upside. Utilities and financials each at 0.5%. And then we've seen downward revisions in this period in real estate, healthcare, industrials, and consumer staples. Fairly small sectors except for healthcare, and industrials is a mid-sized sector, but not seeing massive downward revisions compared to these big sectors right here. If you want to see downward revisions in the S&P 500, you're going to have to see downward momentum in these sectors: infotech, comm services, discretionary, and healthcare as well. And that's exactly what we're seeing. So 2025 earnings shaping up to be very, very good, very, very aggressive in my opinion. 14% earnings growth, the majority of that growth coming from the biggest sectors. And if these S&P 500 earnings come full circle, expect a very, very good year in 2025 on top of what has been so far an exceptional 2024. But the US is not the only region growing their earnings. We can see the same is true here for Europe and the Asia Pacific region. In fact, Asia Pacific seeing forward EPS estimates moving significantly higher than the US as well. And we are seeing, upward momentum in earnings per share growth across the world. Now, while earnings expectations may look very, very aggressive and euphoric, historic, that actually tends to happen in bull markets. This is S&P 500 earnings into bear market bottoms, and then what happens as a result. So this blue line is earnings per share in bull markets. This purple line right here is the actuals plus the estimates of the 2022 bottom. The current path is on a similar trajectory to the historical average based on analyst estimates. So even though earnings are quite aggressive, we are literally just following the average trajectory based on historical norms. So if you think earnings expectations are crazy, you have to take a step back and realize that bull markets are crazy. Ultimately, the fundamental driver of stocks is earnings, but what about a commodity or currency like Bitcoin? What drives the price action in Bitcoin? Because we can actually see that Bitcoin is down 20% in the last month. Now it is up about 28% on a year-to-date basis. So, if you've been holding Bitcoin since the start of the year, you've done very, very well, but you can't deny the fact that it's been a very painful ride in the last month from the 70,000 level here to the 57,000 level as of recording pre-market. Now, the reason why Bitcoin is seeing massive downward momentum actually has to do with fund flows. And here's the thing, regardless of what Michael Saylor is doing or ETF acquisitions or what Bitcoin miners are doing, at the end of the day, when there's no fundamental driver to an asset, it's going to come down to supply and demand. And when supply trumps demand, prices often move lower. Simple supply and demand economics, and this is what we're seeing right now. The net flow of Bitcoin is negative 374,000. Essentially, every single day, every single week, there is net outflows of Bitcoin than there are net inflows, and this includes ETF acquisitions. And as a result, Bitcoin has done pretty much nothing. It's gone sideways for the past 3 to 4 months after a stellar rally in the first 2 months of the year, and it's actually down about 20% in the last month. And until this actually improves, you should expect to see continued downward and or sideways momentum in Bitcoin. So let's dive into the economy and just get an overview of where we stand in the American economy. Now, first quarter GDP sitting at 1.4%, the quarter over quarter seasonally adjusted figure, 2.9% year over year. We just have this month of July to run through. After July, we should get the second quarter figure, and the expectation is about 1.8% or 1.9% depending on what data you look at. However, GDP is still running roughly in line with the 2% trend growth. In fact, we've been above that on the year over year figure for the past 4 quarters. At the same time, what makes up the components of GDP? You can see 4% is housing, 13% is investment ex housing, 17% is government spending, and then 67% is consumption. So the American economy is a consumption-based economy. Now, something that could be affecting consumption is actually excess savings. Excess savings reached $2.1 trillion right here in 2021. However, Americans have actually spent their pandemic windfalls. You can see excess savings are now in the negative, but it's not all bad news, because what we really want to pay attention to now is just the personal savings rate. That was excess savings. Now Americans are actually going to tap into their personal savings. And what we should see over the next couple of months is this slowly increase and maybe level out at about the 4 or 5% mark. If we see a slow and steady increase here in the personal savings rate, that's actually very, very healthy, and that would offset excess savings. But at the end of the day, what really matters is if Americans have jobs. If Americans have jobs, despite what the savings rate, excess savings rate is, consumption will remain robust. And non-farms came in above the consensus expectation of 190K, posting gains of 206,000. Plenty of people in the market thought non-farms was going to come in weak because the ADP numbers previously in the week actually missed expectations, 150 against the consensus of 164. However, the unemployment rate did tick up to 4.1%. The consensus was 4%, and this actually had to do with revisions. So last month's numbers was actually 272K gains in non-farms. These got revised down to 218K, and then the other metric, average hourly earnings, which essentially is wage inflation, came in line, and we saw some pretty hefty revisions. In fact, throughout the month of June and throughout the month of May, revisions actually totaled 111,000 to the downside, and that's why the unemployment rate actually ticked up 4.1K. You can actually see it right here. In June, the reported was 272,000, the forecast was 182,000, and then it got revised down to 218K. So big downward revisions. this meant the unemployment rate ticked up. And there's just no real way to spin this. At the end of the day, the jobs market is loosening. We know this because the unemployment rate is actually increasing. Slightly less people have jobs as a percentage of those people who are employable, despite what the headline numbers. So the labor market is loosening, and we do know this is one of the key indicators that the Fed is looking at when it comes to cutting rates. And as long as the unemployment rate stays steady, consumption should continue above trend as it currently has since the pandemic, as you can see right here. And that's because PCE inflation on a 1-year annualized basis sits at 2.6%. Employee compensation right now is at 5% and disposable income at 3.7%. So the average consumer is actually gaining pricing power. And as long as the job market remains robust and remains healthy, consumption should continue above trend, and this will be supportive of the American economy. But if the labor market continues to deteriorate, it doesn't matter what disposable income and employee compensation is relative to inflation. Less people have jobs. America's GDP is largely dependent on consumption without savings to fall back on. If Americans don't have jobs, we could be in for really ugly economic surprises in the future. Now let's dive into some charts. Guys, this is S&P 500 June seasonality. The S&P 500 just closed out its 8th green day in a row. Kind of crazy, but it's well within seasonality. We normally see very linear price action in the month of July from the 1st all the way up until the 17th, 18th, 19th, sort of around this midway period. Then we have the July OPEX. Then we see a bit of downside. We then actually make a higher low and then continue price momentum, taking out the highs we made pre-OPEX for an average return of 1.3%. And supporting July seasonality is the fact that a lot of these risk-off indicators aren't flashing red. Stuff like bonds versus stocks, staples versus stocks, and volatility versus stocks, right? You want to see these move up in a big way, taking out some of these highs. We're just not seeing that right now. And for the most part, the environment is risk on. You want to own equities because there's more upside coming. When we see a big increase in these spreads right here, that's when we could start to get a bit worried. Another key indicator you should be looking at is the yield spread between corporate bonds and US treasuries. This is actually moving lower, and we're sitting at some of the lowest spreads we've ever really seen since like 2021, 2022. This is very, very bullish. And until we actually see something like this, right, it's a risk on environment and you want to buy the dip